G'day, and we're live. I'm Scotty North. This is Xenium Live, and today I am going to talk to you, with a special guest of course, about our July financial markets update, where we cover all things money markets, stocks, shares, financial instruments, and all that sort of weird stuff to us property people. And today I am joined with PJ Patterson. G'day, PJ. How you going, mate?
I'm good, Scott. How you doing?
I'm good. All right, so we actually got you 3 times in July due to the way that the Thursdays fell on the month, and we did a bit of an update at the first week of July. It would be very interesting to see what your take is. It was happening the last 4 weeks, and I mean, I'm not going to say you were, Eeyore at the first week of July, but I definitely came away looking for a razor blade to attach to somewhere and punish myself. So the point is, am I going to come away happy today, or am I going to come away needing tissues again?
Well, man, I think you'll come away happy today. Certainly, from an economic point of view, there's a number of good signs appearing for Australia and our region of the world, which I'll get into in a moment. I suppose the biggest concern right now is obviously the resurgence of COVID cases and how that's going to impact the way Australia operates. So we know today, or maybe it was yesterday, that Queensland announced they were going to shut down the border and declare all of Sydney, not just the hotspots that we know about, but all of Sydney to be a hotspot. So, mate, I won't be visiting anytime soon because your good premier there has said no mas to Sydney side.
It was, look, I'm not going to say it's premature or not, but it was definitely a broad stroke of the brush. That's what I will say.
Yeah. Well, it was an interesting move, and I suppose it's probably better to err on the side of caution, of course, but this is the running issue that we're going to continue to see crop up, I think, and how it impacts the economy will be unknown for weeks, and whether it continues to deteriorate as it has in Victoria, of course, is unknown. And so we're really going to have to just wait and see whether or not it continues to accelerate and we see the case count rise. Of course, that hasn't necessarily translated into more people dying. Just because you get COVID, of course, doesn't mean you're going to automatically have a death sentence. There's certainly the vulnerable parts of our community that it kind of is a death sentence for, but most people do recover from this affliction. So, but they obviously don't want it to spread. So it'll just be interesting to see whether or not that, closing the Queensland border for a week or two isn't going to make any major economic impact, of course, but it's really what happens next, I suppose, and whether it gets worse from here. But on the positive side, there are a number of great signs for the economy. So where we were at the beginning of July was we had just gotten the June quarter GDP figures. They, of course, were horrendous. We are in recession. We're probably still in recession. But what's happened since then, of course, is the government, as in the federal government, has rolled out a number of stimulus programs to support the economy, support small business, and to really try to get us through this crisis. And I think that's going to be a tremendous positive step on behalf of Australia, because our national balance sheet was quite strong in the sense that we had a pretty low government debt rate. Yes, the RBA had cut rates to, you might as well say it's at zero. They don't really have much else to do in terms of monetary policy, but certainly from a fiscal policy point of view, Australia has the ability to continue to come out with programs and support certain areas of the economy, which they're going to do. And that is the positive, one of the positive things that's going to get us through all of this. The second really positive thing from a global macro point of view is that China, so I'm not sure if I've talked much on your show about this, but my process for managing money is called the 4-quadrant model. It's a full cycle investing model. And when you are in quads 1 and 2, that's good. When you're in quads 3 and 4, that's bad. Well, China has just entered quad 1, which is like rip-roaring growth. In fact, a number of emerging markets have, including Indonesia, Thailand, and of course China, and a couple of others in that region. And that basically means that they're into an economic expansion. Furthermore, the Chinese seem to now be back in the market for a lot of Australian commodities. So I did flick you an article on that. I don't know if you can pop that on the screen, but
yes, mate.
Today we saw Fortescue announcing that they were had been delivering record iron ore deliveries to China. So, it goes without saying that Australia and China are inextricably linked in terms of their demand for commodities and the fact that we have to use a technical economic term, a shit ton of commodities to provide to them. And so for them to continue building out infrastructure, the Belt and Road Initiative, and all the things the Chinese want to do over the next 50 and 100 years, they're going to need stuff from Australia. And so this is a good sign that, I don't want to say the mining boom is back on or anything like that, but certainly the fact that China's buying stuff from Australia again, despite all the geopolitical nonsense going on, is a really, really good sign. What that ultimately means, I suppose, for the Australian economy is we'll probably get pulled out of recession a little bit quicker. And if other things can sort of fire up in the economy and get out of the doldrums, then actually Australia, by I suspect the first quarter of 2021, will be looking pretty good.
Right. Okay. And look, just flicking through this this article, I was going to say here, I suppose we're talking about iron ore has cracked 100 billion in annual export earnings, and the commodity price is now over US $100 a ton. So you're someone who follows a bit of that. That's obviously an important milestone.
Yeah, it's a big milestone. So obviously the price per ton of iron ore is an interesting metric to follow. I think at the height of the commodity boom back in sort of 06 to maybe 08, 09, iron ore was trading at around $150 a ton US. So there's still clearly a bit of headroom there in the iron ore price. I think at the absolute lows of the global financial crisis, and then subsequently iron ore dropped to I want to say about $40 to $50 a ton on the spot market. So clearly it's come up probably stealthily, because you haven't really heard much reported about the iron ore price. I must admit, it's not a commodity price that I follow on a regular basis, but clearly at $100 US a ton, that's good. The other issue, of course, with that is the US dollar has been falling quite precipitously over the last 30 days at least. It's re-entered a bear market. And as such, everything priced in US dollars, i.e. iron ore and any commodity, which 90% of them are priced in US dollars, is going to rise. So the other part of that equation, the iron ore price being US $100 a ton, is the fact that the US dollar is being debased at a rapid pace by the US Treasury and the Federal Reserve.
Yeah, okay, that's a good point. And that's something I'm going to ask you about later, which is gold markets, because there's been some highs there. So also on other links that you sent me, you've got some other things. What do we got here? We've got Macquarie profit slightly down.
Yeah, so one of the issues that I would have discussed at our last economic update was the fact that we are still in a corporate profit recession, and we still have a little bit of time to go with this workout period where corporate profits will continue to probably be down and reported poorly, just probably for the next quarter, maybe 2 quarters, as the profit of the earnings through the COVID shutdown and then the subsequent restart, and arguably a slower economy will get factored into corporate profits and corporate reporting. So I just spotted this article today from Macquarie, who has one of Australia's 5th largest banks, I suppose, is certainly a bellwether in terms of this. I don't know what this will tell us about the rest of the bank's earnings, but I think, and there was an article yesterday or the day before about the fact that APRA has told the banks to cut their dividends or to not pay dividends, instead taking that excess cash flow and shoring up their balance sheets. So again, there's obviously some concerns out there at the moment. I would say in financial land, financial institution land, that they, continue to have strong balance sheets. But broadly speaking, we will still continue to have a workout period for corporate earnings, both in Australia and in the U.S. So we're definitely not out of the woods yet in terms of things like valuations, stock market valuations and such. But let's put it this way. We are seeing some positive signs in certain parts of the economy that should do well, as I said, with the U.S. dollar falling, and then China and parts of the emerging markets in Asia firing up again.
So the APRA's request to banks to not pay dividends is based on the requirement. Well, they perceive a requirement to be more cash intensive than if they would pay out the dividend. Is they want more cash on balance sheet? Is that what I'm hearing?
Correct. So basically what APRA is saying to the banks is that for the moment, suspend your dividend payments because we want you to keep that cash on the balance sheet. We want you to keep that cash in the business on the off chance that we see more loan losses. So we see more consumers unable to pay their mortgages. And as such, we go through a sort of a consumer balance sheet recession. We're sort of in one right now. But certainly the concern would be the health of our four biggest banks and obviously our entire financial system to make sure that we can weather any sort of hiccups that may come down the pipe around higher loan losses, that sort of thing. Hopefully nothing like that will happen, and the banks will just be able to pay, an extraordinary dividend or something like that down the track. But I think it's a smart move to ask the banks to keep that cash on their balance sheet in case there's some other, extraneous event that comes along. Maybe COVID-20 is coming along. Who knows? Sounds like a cleaner. COVID-20. But in any case, being prepared for a shock is, I think, effectively what APRA is asking the banks to do.
So COVID-20, are you going to patent that? Is that part of your,
And I'm going to go get that as a license plate as soon as we get off the show.
Yeah, okay, all right. Well, look, one of the articles that you sent me is actually about gold. So let's take a look at that one because I had some questions on that myself. Markets may have jumped the gun on gold. So I was reading this week that gold's hit, all-time highs, et cetera, So we're a big discusser of gold. Well, you are. I just like wearing golden things and what have you, but you're a big believer in gold and the history behind it and all that, and we've covered that. If you missed that on previous episodes, look it up because there's a really good episode we did on gold and the history of it and why it's still important now, and check that out on the Zenium Live podcast as well as our back catalogue and at YouTube and on our website. But PJ, tell us about gold right now. So it's hit new highs. What does that mean? Is that newsworthy?
It's absolutely newsworthy. So there's a couple of things, and I sent you this article because I love these Muppets in the media who absolutely do not understand gold. And I just love this headline, markets may have jumped the gun on gold. And that article is really talking about gold's relationship to inflation. Now, it's well-known fact that gold is a tremendous hedge against inflation. But typically what gold is and does is it's kind of the canary in the coal mine. Gold is suggesting and signaling that we may begin to see some inflation, but by no means gold's current run, which it's gone from, I think a couple months ago was around 1750, 1800 an ounce, to hitting a new all-time high, and today it's trading around 1950, give or take $10 US an ounce. But what it's actually signifying, two things. Gold loves low interest rates. So what gold is suggesting is, first of all, interest rates aren't going up anytime soon. If there was any chance at all that interest rates were going to be rising, gold would be falling. That's item number one. Item number two is gold has an inverse relationship, and its inverse correlation to the US dollar now is almost 1-to-1, which basically means that as the dollar continues to fall, gold will continue to rise in US dollar terms. So the gold is priced in every currency, and it has relationships to everything. So in some currencies, gold has been ripping to new highs for months now. The U.S. dollar, not so much, but until of late. But certainly what this is showing us is the gold price in U.S. dollars and Australian dollars, for that matter, is hitting new all-time highs because of currency debasement. But again, back to the first point, it's really suggesting that interest rates aren't going anywhere anytime soon. I suppose there is a third point on that, and the third thing is it's also anticipating or discounting geopolitical risk. So gold is often used and referred to as a safe haven asset in times of political or geopolitical turmoil, and there's certainly a few hot spots. The relationship between China and Europe and China and the US and even China and Australia seems to be a little bit strained at the moment. So gold is sort of reflecting and responding to all of those things. It's a trifecta, if you will, of things that will probably continue to drive gold higher. Obviously, there'll be corrections along the way, counter trend bounces and counter trend drawdowns and so forth. But I think gold is in a bull market for at least the next couple of years.
Right. Okay. And so the final article we've got here, we'll take a look at, is Australia slips into deflation after CPI suffers biggest quarterly loss in 72 years. And that's just under our ad there to be able to buy masks.
Yeah.
So it's pretty cool.
Yeah, it's interesting, right? The thing about deflation is, first of all, the CPI. I haven't really delved into this too deeply, but the CPI, Consumer Price Index, is a flawed index to begin with because of the way the index is now structured. It's actually structured to try to make inflation not seem as bad as it is. So the fact that the CPI is showing up deflationary pressures is very, very interesting. That's great for the consumer because it should mean that things are getting much cheaper. But I don't know about you. I remain a little bit unconvinced about this because I know the cost of healthcare and other just daily costs of living seem to be rising, insurances and so forth.
Yeah, I haven't seen anything necessarily go cheaper, mate.
Yeah, I'm not sure what part of the CPI has contributed to this deflationary pressure, but it's what's interesting about it is our central bank, of course, and most central banks around the world are targeting inflation. They're trying to generate inflation. And so the fact that our CPI indexes, and ours wouldn't be unique, we're seeing similar stuff in the US, although again, gold and the US dollar falling is going to signal a little bit of inflationary pressure. But it's just interesting that, we seem to have some deflation. And what that means for interest rates, I don't know. They may continue to cut. They might try to go negative. It's anyone's guess on that one. So that's certainly something to continue watching.
Okay, so this is what that line there is saying, that Australian Bureau of Statistics annual inflation rate was negative 0.3 in the 12 months to June 2020. So that's like negative growth, mate. One of my favourite terms, negative growth.
Yeah, I know. The fact that they would say negative 0.03 is just stupid because you can't have an annual inflation rate that's negative. That's called deflation. So whoever wrote the article needs to be educated on what inflation and deflation is. They should have just said, the price index deflated by 0.3%. But that could very well be a one-off. It wouldn't surprise me if that would obviously have been due to the fact that people were not out spending, they weren't consuming as much. The demand for goods and services and commodities would have been, way down because of people being sequestered at home due to the COVID crisis. So that's probably a one-off quarterly thing, and I'm sure that the next number will probably show inflation. It might be nominal, it might be only a small amount, maybe 0.5% or something like that. But
if they did that, mate, they could call it deflation of negative 0.5%.
Yeah, that's what they should call it.
And then that would actually mean inflation. So we could confuse people all day long. I mean, I'm very good at that sort of thing. So we might just move on. So the only thing that I was thinking is they do an inflationary basket. Maybe the baskets got cheaper, mate. Maybe that was the one thing that actually got cheaper. was the actual
Yeah,
basket
hard to
they
say.
measure
I
in.
mean, on balance, I would say that the basket of goods, most of the things in that basket obviously fell in price, which would be why we saw deflationary pressure. But there would certainly be some things that would have gone up. Again, I already know that things like healthcare, and there was one other one, I forget what it was, but it was healthcare had risen. I think just general insurance costs had gone up as well.
Yeah.
As the U.S. dollar continues to fall, we will see oil prices rise, and that, of course, will translate into a higher price at the pump. So things like energy costs and so forth should probably begin to rise again.
Yeah, no, that's something to really look forward to. I thought you'd give me good news. So, what is the good news? What can people do to make money in this time? Like, I mean, you've definitely peppered my day. I don't know if I'm going away with tissues or without, but there's got to be some sort of, idea of what we can get into in the coming months.
Yeah, sure. Well, I can tell you what I'm doing with my own client base, and certainly in my advice business at the moment. I am starting to allocate more capital now to a couple of areas of the market, being momentum stocks. So things like tech stocks. Tech is a rip-roaring buy in this sort of economic environment. So all of your FANGs and other tech type stocks should do very well. Your secular growers, so things like Amazon, which is for all intents and purposes a tech stock, will do quite well during this period. And interestingly, things like some of your small caps and some of that stuff should also start to come back into favor. But the top sort of things would be tech and also anything that's interest rate sensitive. So gold should be a large allocation at this stage. And then you can just sort of buy the large cap, big cap stocks, things of that nature. They should all start to fire up as well. Things like consumer discretionary as the consumer recovers, things of that nature. So there's any number of picks that you could talk about there. I tend to just buy indexes and ETFs that give you a broad exposure to these market segments. But certainly I'm pushing more money into the middle of the table now because, again, China being in Quad 1 for at least the next few quarters is going to begin to pull Australia out of its doldrums. And if we can possibly see the reopening of our international borders and maybe the return of students and a bit more travel and tourism, I mean, that's a big question mark, of course, but some of those things beginning to happen, then Australia's economy should start to fire up a little bit, and that'll be good.
Well, that will definitely be good, and also be good for the sector of the industry I work in, which is property, which seems to be grabbing a lot of headlines at the moment. And to be honest, there's just a whole bunch of information where it's going to crash, it's going to grow. I've never been busier. I'm not doing anything. Mate, there's a whole range of sentiment within the industry, let alone from without the industry. So I think it's going to be an interesting one to watch. But I have definitely heard some very interesting stories of things that have happened in the past 6 months in property, where I've got a mate who's sold his biggest year ever in real estate. He's been doing it for 10 years. I've got a commercial builder who sold everything out in weeks. Normally it takes months. I mean, this is the sort of weird stories that I'm hearing around the place, let alone the land that's based on the government grants and stuff. That's just we've already covered that topic.
Well, certainly with the interest rate environment being this low, and there clearly being a slowdown in at least residential, the movement of residential property prices, the first home buyer, I mean, this is one of the best environments right now, and I'm seeing this in my business as well. A lot of first home buyers are coming out of the woodwork. I think they've been waiting for a while for an opportunity like this. Millennials who probably thought they would never get into the property market are all of a sudden being given an opportunity, and a great opportunity at that, with, again, as you just mentioned, the government grants, low interest rates that are going nowhere probably for the next 2 to 3 years. Those aren't my words, those are the words of the central bankers. And I think continued government stimulus programs, which, whilst they have put a use by date on some of them, I think that they will have to extend them and they will want to extend them because they'll want to have that sort of, if the government's going to fiscally spend, they're going to want it to go to things that are, reasonably productive assets that can support industry, small business, and so forth. So clearly, the property sector is one of the largest ones. We've talked about that before. They want to continue to support that. So I think the first home buyer, if there's first home buyers watching this show, I would be very inclined to get out there and have a look around. But you also just touched on industrial and commercial type properties. Those seem to be doing quite well. I echo your sentiments on that. That particular segment of the market has been quite firm, and maybe small businesses and stuff are taking the opportunity now to secure their own spaces and things like that. So it is going to be interesting to continue watching that.
Yeah, look, I agree. I think one of the things that I've seen over this time, and tell me if you've seen the same thing, is that there is, there's a lot of people that are hurting, but there's some people with some cash, equity, whatever, coming out of the woodwork, mate. And they're not necessarily, some of them are waiting for blood in the waters, but some of them are just deciding to act now. Have you seen that yourself? And if so, what drives that mindset?
Well, I have seen that, and typically I think it is off the back of people who have been through a couple of cycles. So clearly, these are folks who were around during the early 2000s. They experienced tremendous property growth in their property portfolios. They're probably buying property. They went through that cycle, made a lot of money, and they're now deploying it in various ways. And what I'm finding is that, particularly in the property space right now, is people are sort of allocating capital to development of property, and specifically in that sort of commercial type space, or not residential as such, but things that are maybe a little bit different that we know are needed by our economy, our small businesses, and so forth. So people are coming out of the woodwork with capital. They've obviously always had it. Not always had it, but they've had it for a while. They've been waiting for an opportunity, I guess, to feel safe, feel like it's okay to go back in the water, as it were. But they are doing that. They are coming out. So that ought to be a signal that, people typically, because they are the market, when you see that sort of activity, well, you ought to take note. And I think both you and I are dialed right into that at the moment in terms of taking note of that. So we'll just have to keep watching it, Meg.
Yeah, no, I think that's a good point. All right, well, look, thank you again you've seen us 3 times this month. You're probably tired of us now, but mate, thanks for being on again, and we'll see you in another fortnight for a session, a topic session that we'll delve into. But I won't need tissues. I can't say I'm going to run out of here and throw the party poppers and the party hats on, but at least I won't need tissues today, so thank you for that.
My pleasure. I think, the summary of it all is that I am hopeful that the worst is over, and as long as we don't get another, big spike in COVID that spooks the government to where they shut down the economy again, I think we're all well and truly on the road to recovery, and now it's just a matter of, just keep going day by day, wake up every day, God willing, 2 feet on the floor, get stuck into it, and try to do something good for Australia.
Yeah, look, I agree. PJ, thank you very much. Today I was joined with PJ from Keystone Financial Services. He joins us every 2 weeks on a Thursday afternoon when you should be sitting listening to us having a cup of tea and a cookie. And you can catch all our episodes on the Zenium Live podcast. So that's at all your good podcast sort of providers. Also, we stream live on Facebook, YouTube, Twitter, I don't know, whatever else. We're global, we're everywhere. So look us up, watch back episodes. Also, PJ loves feedback, so feel free to give that. And I love ideas for new shows because whilst I could just talk your ear off and, everyone loves the sound of my own voice, just like me, I actually like to talk to you about something that people want to know about. So feel free to hit us up on the email below. It's been scrolling. For those of you listening on the podcast, just go to www.zenium.property and you can join us there. You can call us on 1300 667789, or you can email us at hello@xenium.properties. There's no .coms, no .aus, and Xenium is XENIUM. All right, PJ, thanks very much for joining us again, and we'll see you in a couple of weeks.
See you then. Thanks, Scotty.
All right, I'm Scotty North. This is Xenium Live.